Hello, friends. In today's podcast, we are going to learn about which is better, mutual funds or ETF. And we also learn about very much in details about ETFs. So, friends, mutual funds are better for those pupils who do not see market anyway, and or we can simply say that they don't have any understanding any knowledge about financial markets, or they simply want to invest in the markets and get the returns what the provided by mutual funds managers. And ETFs are the electronic traded funds that trades on the exchanges. And in my view, ETFs are much better than mutual funds. However, it depends on your personal finance and your choice. If you are the person who don't want to see the markets on interval basis or daily basis, and he don't have any knowledge about ETFs equity market, then he should go with mutual funds and invest in mutual funds in SIP mode, that is systematic investment plan. So the SIP cuts from your accounts on definite interval decided by you, like monthly, weekly, or yearly, anything that you decided. And if you are the person who have little knowledge about markets and how markets work and how to operate the apps for investing or trading, then you should go with ETFs. And we later discuss why. There is some drawbacks of the mutual funds, which especially come let me come to this point that mutual funds are not better, especially for me and not for you in that maybe. So for me, mutual funds are not better because mutual funds charge a huge expense ratio, and there is also a exit load. Think about it like this: if a mutual funds provide you annual returns of 12 or 13%, say 13%, and if it charge 1% as a expense ratio and charge 1% as exit load if you withdraw money from your decided period, then you lose 2% in your overall portfolio value. When you see the app, or when you see discuss with the mutual fund providing managers, that they provide you 13%, but in actual you get only 11% return, because 1% in buying you pay as a expense ratio, and 1% during selling you pay as a exit load, and these may vary. I am just talking about general. At the place, ETFs charge very less as compared to mutual funds as expense ratio. Generally, ETFs charge 0.05 or lesser than that in ETFs, especially for the big indexes like Sensex, Nifty 50. However, some ETFs also charge high expense ratio, but that is not as high as the mutual funds. Maybe some ETFs may charge you about zero point 0.5, 0.6% expense ratio. But for the same theme or for the same stocks, mutual funds may charge the double or triple. So this here is the clear point that expense ratio is much lesser in comparison of ETFs. Another thing is that ETFs don't charge the expense raise, the exit load. So you can sell the ETFs at zero exit load. When you want to sell, you can sell at that point. Another important point is that buying the mutual funds at spot price is not possible. I can understand. So you like this: if today's market is down by 10%, and or 1%, 2%, anything, and you want to buy your mutual fund at that point, but it is not possible. When you pay money to your mutual fund agency or to the app from which you buy, that app or that fund or that agency will allot you the NAV of mutual funds of the next day or of the same day, but it depends on the manager or the agency and it not in your hands. So in that case, generally people lose 1 to 2% of the market fall. However, it is not possible in case of ETFs. In the case of ETFs, you open your share market app and buy the ETFs from the exchange or from the app at the spot price at which you want to buy. So if market is down by 5 to 10% or 1% or whatsoever, you can get the ETF at that spot price and you know at which price you are buying the ETFs, but you don't know at which price you buying the mutual funds. And because NAV is decided at the end and that NAV is not in your hands. So this is the another difference. Now we know from up to now that ETFs are much better than mutual funds because they have very low expense ratio, they do not have exit loads, and you know at which price you want to buy. Now another benefit of the ETF is that you can sell ETF and get money quickly because it is like shares. You can sell the shares and get money in your broker account, and within 1 to 2 days you can get money in your bank accounts. But mutual funds may take longer time. Now come to the point, which which ETFs in India is better to buy. So if you want to buy the Nifty 50 stocks, then there is a ETF called Nifty Bees you can buy. So expense ratio of Nifty Bees ETF is 0.04. You see how low this expense ratio is? 0.04. And its P is currently trading at 23.5. And this ETF gives the return of 29% in last 1 year, and in last 3 year this ETF Nifty Bees give the return of 15.9%, and in last 5 year this ETF gives the return of 19.3%, and it is currently trading at about 276 rupees. So friends, this way you can buy so many ETFs. If you want to buy the next 50 stocks of the in, Indian economy, then you can buy the junior Bs whose expense ratio is 0.17 and which is currently trading about at 26.8 PE ratio. And this junior B's ETF gives 1 year return of 68.5% and 3 year returns of 24.5% and 5 year returns of 24.7%. Dear friends, there may be minor variance in these returns or prices or P ratios as they change frequently. Now, next ETF, if you want to invest in mid cap companies, then there is a ETF in Indian Stock Exchange NSE which you can buy is mid cap ETF. So mid cap ETF is trading at an P ratio of 34.4 and it have expense ratio of 0.05%, and in last 1 year this ETF gives return of 49.8%. Dear friends, if you want to invest in small cap companies, and then there is an very good ETF by HDFC Bank itself or HDFC Asset Management Company. That ETF is HDFC SML 250, which represent HDFC small cap 250 companies. HDFC SML 250 ETF have an expense ratio of 0.20% and it is trading at PE ratio of 26.8%, and in last 1 year it gives returns of 55.8%. If you want to invest in government companies of India, then there is a ETF which is CPSE ETF, and it is trading in at an expense ratio of 0.07% and P ratio of 15.9%. In last 1 year it gives tremendous returns. It just double your money and gives the returns of 112.7%, and in last 3 years it gives the returns of 60.3%, and in last 5 years it gives the return of 35.6%. So friends, this ETF is very good ETFs and it just double your money in last 1 year. However, there is a risk always with ETFs also, as in stocks, as in mutual funds, as in all equity linked schemes. So be prepared to handle or take that risk also. Another good ETF to invest in MNC companies of India is MNC. Simply search on your app MNC and you see the ETF. This ETF you can buy at an expense ratio of 0.30%, which is trading at a P ratio of 50.4, and in last 1 year it gives a return of 42%. The P ratio of this ETF is very high, that is 50.4, because it invests in MNC companies, and generally MNC companies are trading in stock market at a premium valuations. So that's why this ETF have a high PE. Dear friends, there is a good ETF to invest in other asset classes also, like gold and silvers. If you want to buy or invest in gold, then you can invest in gold bees. Gold bees ETF is tra- is you can buy at an expense ratio of 0.79%, and in last 1 year this gold bees ETF gives the return of 20.7%, and in last 3 year it gives the returns of 13.4%. In last 5 year it gives the returns of 11.8%. Another ETFs to invest in silver is silver bees, which is trading at an expense ratio of 0.56%, and in last 1 year it gives the returns of 15%. If you want to invest in past banks of India, so you can buy the Bank Bees ETF. This ETF is trading at 0.19% expense ratio and its P is 15. In last 1 year, this ETF gives the return of 15.3%, and in 3 year it gives the returns of 13.9%. In 5 year this ETF gives the return of 13.6%. Dear friends, if you want in debt funds, and then you can buy the ETF which invest in overnight debt funds, that is liquid bees. So liquid bees is trading at an expense ratio of 0.69%, and in last 1 year this liquid bees gives return of 3.2%, and in 3 year this gives return of 3.7%, and in 5 year this gives return of 3.2%. So this ETF is not for getting the returns, it is to secure your funds. So it gives very less return of about 3%, but it secure your money and give you opportunity to invest in the recession or downfalls of the market. Another good invest to in Another good ETF to invest in GSEC securities. This ETF is we especially invest in bonds or GSECs. So this ETF's name is GSEC 10 year. So this ETF is trading at an expense ratio of 0.10%. In last 1 year, this ETF gives return of 9%. At the place of liquid bees, you can also buy this ETF GSEC 10 year, but it depends on your risk ratio profile. If you want to invest in IT companies of India and you do not want to buy the direct stocks of Infosys, TCS, L&T, then you can simply get the ETFs for of IT companies, because these ETFs trade invest in all the stocks which are in the IT index of the exchange NSE. So this ETF is ITBs, which is trading at an expense ratio of 0.22% with a PE of 33.6 and give returns in 1 year, in last 1 year as 35.2%, and in last 3 year 8.4%. So friends, these are some of the ETFs which are very good and better. However, there are some other ETFs also, like if you invest in the companies which is related to health sector, then you can buy the ETF healthy ETF. I explain this ETFs is very good because it invest in health sector, and health sector is a recession proof sector. So in COVID this sector also grow very well, so you can also consider this sector as per your risk profile. So spelling of this ETF is HEALTHI ETF. So you can invest in this ETF. So it is trading at an expense ratio of 0.15%, and currently it trading at a P valuation of 40.1, and in last 1 year this gives the return of 47.2, and in last 3 year it gives returns of 17.7. If you want to invest in real estate, then you can buy the ETF whose name is more morality, MOREALTY, which is trading at an expense ratio of 0.40% and at a PE of 58.4%. Dear friend, along with these ETFs, recently a ETF which invests in liquid is launched by Zerodha is the liquid case, so which is trading at an expense ratio of 0.26%. You can also invest in that ETF. And if you want to invest in US stocks or good US stocks from India, and you do not want to buy direct stocks, however, there is an option of buying direct stocks of the US company with the apps like IND Money or other apps also launch to invest in US stocks, but that is little bit not good for the persons who are not updated or not good at to managing that. Then they can buy the ETFs to invest in US stocks. So one of the best ETF which I also consider to invest in US is MON 100. MON 100 is trading at an expense ratio of 0.58%, and in last 1 year this ETFs gives the return of 32.0%, and in last 3 year it gives returns of 13.8%, and in last 5 year it gives returns of 24.5%. Along with, if you want to invest in other US related ETFs, then there is a ETF MAFANG, MAFANG, which is traded at a expense ratio of 0.66%, and in last 1 year it gives returns of 47.5%, and in last 3 year it gives returns of 20.8%. Another good ETF is MASP 50, MASP 50, which is traded at an expense ratio of 0.65, and in last 1 year it gives returns of 34.4%. Another ETF is MONQ 50, which is traded at an expense ratio of 0.40%, and in last 1 year it gives a return of 19.9%. If you want to invest in Hong Kong market, then there is an ETF to invest, that is Hang Seng Bees, HNGSNGBEES, which is traded at an expense ratio of 0.93%, which gives return in last 1 year about 4.1%, but in last 3 and 5 year it gives negative returns of 4.7% and 2.1%. So I generally give you this ETF for your information, but I don't think that you should invest in this Hang Seng Bees ETF. Invest in US ETFs and Indian indexes ETFs is much better. So now this is about ETFs. I also share with you a link of the small case which you can consider for your knowledge purpose to invest in ETFs. Thank you to listening this episode. Episode is by your host Jitendra Singh Sandhu at Sandhu Value Investing. Thank you to listening this episode.